Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering a topic I had with another investor on my Facebook group. He was going over the stock SWK, which I recently added to my portfolio. He had asked the question, why invest in a stock that only gives you a 1% dividend yield when you can invest and get a 6.6% return with AT&T, and 8% with OHI, and 11% with AGNC. So he said the SWK, or Stanley Black & Decker, seemed a bit bloated. And my response was that Stanley Black & Decker, while it does offer a lower dividend yield, it often has a higher dividend increase. It's more reliable. It's been providing dividend growth for much longer. And over the long term, it had a much higher return on average than, say, for example, AT&T. So I thought it would be kind of a good idea to do sort of a comparison video. So that's what we're going to be doing in today's video. We're going to be comparing ticker symbol SWK to AT&T, OHI, and AGNC inside of a portfolio. So I recently added Stanley Black & Decker to my portfolio just a few weeks ago. Now, initially, I saw this company. I looked over their financials, their balance sheet. I said that this was at a great buying point. They were trading below their 50-day and 200-day moving average. They had quite a bit going for them. They've had triple digits return in their revenue, net income, free cash flow. And they were buying up a brand new brand, adding it to their sort of like arena of items to sell. So overall, great looking company, had a lot of good growth within the last few years, and has had great growth in the dividend area as well, providing a good return and growth for the past 40 some years. So added to the portfolio. I didn't know where the bottom was at, but I knew it was trading near the bottom. So it did go down slightly initially at the beginning, but since I've invested in there, I've made a 6.56% return. Plus, I've got paid out some dividends from the stock. I've made $1.88 and earned dividends just from investing and buying the stock prior to its ex-dividend. It was actually one of the stocks I covered on Stocks with Ex-Dividends next week. If you haven't checked it out, I make articles every week on my website going over 5 stocks for the next week that have ex-dividends, the best stocks to invest and such. But I never included the, if you do like the video, hit the thumbs up button below. And of course, if you're brand new, hit the subscribe button. So I'll add that little lingo in there. So in this video, we're going to be doing a quick comparison, and then we're going to be going over and taking a look at the stock return calculator, and then take a look at the payout ratio of each of these stocks, how much they pay out, how long they've grown their dividend, and for how long and such. So we're going to be doing a quick comparison of these stocks. So Stanley Black & Decker, AT&T, Omega Healthcare, and AGNC Investment Corp. All of these stocks are dividend stocks. They all have and provide a dividend yield. They pay out dividends. So Stanley Black & Decker down here at the bottom at 1.66%. We have AT&T with a 5.95% dividend yield. We have Omega Healthcare at a 7.97%, and we have AGNC Investment Corp with an 11.51%. So very high dividend yield, very low dividend yield. Now, if we take a look at these dividends that they paid out, or we're just looking at the year, so that's fine for the price or the dividend yield. So that was current dividend yields. Now let's look at the dividend payouts since, for the past 10 years. Now, if we want to take a look really quickly, we can see that AGNC has cut their dividend. Going back 10 years, they cut it, and now they're paying out 18 cents per share. They probably had a couple, without looking, we'll look here in just a minute, but I believe they probably had a couple stock splits, which is why they've cut their dividend. But if they haven't, they've just been, cutting or freezing their dividend. And just kind of looking at these, I would much, and I'm just going to go ahead and take this out, but I would much rather have a very safe and reliable, steady dividend grower that's been growing their dividends. They have a low payout ratio. They're not going to cut it. They're not going to freeze their dividend during downturns. They're going to just continue to increase it, raise it up. It may not be a high dividend yield, but they're paying out something, plus you're getting a good return, and it's pretty safe as far as a niche goes, or a specific moat. So so we've kind of covered that. Dividend wise, we can see Stanley Black & Decker very steady and growing. AT&T, let's go ahead and just look at these in percentage. It's going to give you like a better rate of how they have moved over the last 10 years. So Stanley Black & Decker on average has increased their dividend by 10.6% on average per year. Omega has increased their dividend payout by roughly 12% on average per year. AT&T is a very slow dividend increase. They only increase their dividend on average per year of 2.1%. That's very low. I like to invest in stocks that have they increase their dividend percent by at least 7% or higher on average per year. So Stanley Black & Decker hit the nail as far as 10%, 7% or higher there as far as dividend growth, and they also have about 40 years of dividend history behind them, just raising their dividend year after year. Here at AGNC, they cut their dividend by 85% since back 10 years ago. Now again, this could be due to a stock split, but we'll check that out here in just a minute. Now, when I look at these companies as well, I like to see a steady rise in their revenue, free cash flow, and net income. So Stanley Black & Decker has increased by triple digits across revenue, free cash flow, and net income. It's all pretty steady. There's nothing spiky there. There's a couple instances. We had that recession back in 2008, but we moved out of it and just have been steadily climbing, generating more revenue, net income, free cash flow. AT&T, they've been pretty stale between 08, 09, and recently 2017. We can see going into 2018, they have recently increased their net income by quite a large amount. Here we have their free cash flow and their revenue is up. Now, if you take these numbers here and just divide it by 10, that's going to give you your average per year that they move up. So revenue only up 2.8% on average per year. Net income looks like it had actually been negative up until that tax reform. So they're currently showing about a 13% return on average per year if you had been invested this entire time. But if you had invested in this company, over the long term, your return, here's your price change. Over the past 10 years, their price has changed 9.89% there. That's not including like if you were to reinvest dividends. We're going to do that here in just a minute. Okay, and then we had Omega Healthcare. A couple of solid numbers there. Very low net income their return. And AGNC. This one had some very high revenue, high net income, and some triple digits, near thousands, and the free cash flow as well. So strong looking financials there as well. So overall, I believe that was just about all I want to cover here. Now, kind of moving over and taking a look here at we want to look at their payout ratio. How likely are they to cut their dividend, say during a downturn? How much of their earnings are actually getting paid out to shareholders? And how long have they had continued dividend growth? Because I'm investing for the long term, and these companies are just going to pay out a dividend regardless if the market turns sour and it goes down. And they're also going to be providing a very healthy return. So Stanley Black & Decker, they're currently priced at $153.83. They have a payout ratio of 31.5%. Their earnings per share is $8.39. If you were to take this number, divide it by the current price of the stock, that would give you a payout ratio of 31.5%. So very low payout in comparison to their total earnings. How long have they been increasing their dividend? They've been increasing their dividends for the past 50 years since 1968. So would I consider this one a very, recession-proof stock? Yes, I would look at it and say, that more than likely they're not going to be cutting any sort of dividend. They're going to be continuing to raise their dividend even when they do stock splits. Stock splits, instead of 100 shares and I'm getting $100 for their shares, they're going to split it. I now have 200 shares and I'm getting $200 for my dividend. So they basically just double your dividend there on a stock split. They didn't even cut the dividend. They just continue to pay out 18 cents per share, and they raised it for each share you had. They basically just doubled your dividend pay there. So solid company all around, very steady in all their financials. AT&T is next. AT&T, again, a little, payout ratio a little bit higher. They're currently priced at $33.44. Payout ratio at 56.8, still healthy. I would think anything below a 60% ratio is considered healthy. Dividend growth since for the past 33 years, since back in 1985. That's a great year right there. Down here towards the bottom, they did do couple special payouts. They've also done stock splits back in 1988. And just been very steady, very slow moving. I don't think we went over the price movements in these over the past 10 years, but we can just hit that in real quick. You can see here Stanley Black & Decker, 225% price return over the past 10 years. Then we have Omega Healthcare at 73.14. We have AT&T at 9.89, and AGNC Investment Corp at a 0.48% return for the past 10 years. Now, this doesn't include dividends. This just includes the price movement, or the price change. Now, this doesn't include the dividends wrapped up into the price, because when you get the dividend, it pulls it out of the stock price, and it's actually not included in this information here. We'll cover that here in just a minute. We'll look at the numbers with dividends reinvested as well. So next we have OHI. We have Omega Healthcare Investors. It's the REIT. They've been growing their dividends since 2010, so not quite through the recession. They must have cut it or froze their dividend. It's a REIT, so payout ratio a little bit higher. That's expected. They have to pay out over a certain amount for tax purposes. But what do they do here? So there wasn't any sort of stock split. This company stopped paying a dividend between 2000 and 2003. After 2003, they raised their dividend here, very steady, and then looks like in 2015 they cut their dividend and then continue to raise it. So during the downturn here, it looks like they locked their dividend just for a few years between 2008 and 2009. Okay, so yeah, just about 2 years they locked their dividend, didn't increase it, and just kind of locked it out until they could make sure they were able to pay out what they were supposed to pay out, and then continue to pay out those dividends. So if you had stayed in for the long term, you may have made a nice return, seeing that they have an 8.05% return, but I would consider this one a little bit more risky, especially during downturns. I would see them as cutting their dividend, and you'd more than likely want to get rid of it out of your portfolio instead of holding it. So it's not paying you anything. The price would have tanked at that point as investors are jumping out of it because they cut their dividend, they stopped paying a dividend. So a little bit riskier to invest in right there. And then we have ticker symbol AGNC. This is the American Capital Agency Mortgage Investment Dividend Growth. Haven't had any sort of dividend increase for the past year. Payout ratio at 88.5, meaning that they have a very high payout ratio in comparison to their earnings. Their earnings per share are $2.44, and they pay out $2.16 of their earnings per share each year. So that's a very high amount, meaning that if they were to go like south, this one would probably more than likely cut their dividend here. Now let's look here down towards the bottom. We look at this company. They started paying a dividend right after the recession in 2008 and increase it. Then they decrease it. Let's go ahead and get rid of that. So started it off, increase it slightly, decrease it, increase it, and then just kind of locked it in at 40 cents, $1.40 per share up until looks like 2011, and then just have been decreasing it since then. And lately they're paying out 18 cents per share, which their stock must have gone down by quite a bit within just the last couple years. Let's just look at AGNC here. Yeah, down over the past 3 years, they're down 3.35%. You still would have got paid out that dividend, but would it have been worth it? We'll see here. I don't know if the math is actually correct on this, but we'll take a look at it. So those are the 4 stocks that we're kind of comparing SWK to. So looking at SWK, very low payout ratio, dividend, history of raising their dividend, and just very steady, very solid looking returns and splits and doubling your dividend. So now I wanted to go and look at the stock total return calculator. Now all of these stocks are between January 2nd, 2009 and January 2nd, 2018. So this is a 9-year comparison. This graph looks like it depreciated here back in March 2018. That's why I could not go all the way to current time. So here we're looking at ticker symbol SWK. If we had invested $10,000, reinvested all of our dividends, We can see if we go all the way back here to 2009, we're getting paid out 32 cents per share each quarter. They raised it 33, 34, 41, 49, 50, 52, 55, and so on. So SWK continued to raise their dividend payout and their stock price to increase. So the final result, if you had invested in SWK back in January 2nd, 2009, would be $59,014.15. That would give you an annual return on average of 21.79%. Now, we look at AT&T, going the same thing, January 2nd, 2009 till January 2nd, 2018. We look at these numbers. We started with $10,000. They were paying out 41 cents per share each quarter there per share. You can see a little bit slower growth there, only a cent, 41, 42, 43, 44, very slow dividend growth. 2% on average per year, which is basically a cent. So very low. Your final return after 10 years of having $10,000 sitting in AT&T, you would have a final total of $21,489.42. That's an average return of 8.87%. So not anything to shake at. Next is OHI. OHI, again, same numbers, January 09, 2018. If we had started with $10,000. This one, I don't think they cut. Did they cut? What was this? OHI? I like this graph. Yeah, they did. Okay, okay, I'm only including 2009. So here they've had actually a pretty steady dividend history here during this time. So we're not going to look at it over the long term. So OHI, they've had very steady increase there since we started investing in this one. There was a slight cut, which is, where was that? There was a cut here in 2015. 2015. So right in this range. Looks like they went from 53 cents to 36 cents to 18 cents, then back up to 55 cents. They recovered there. So if we had started with $10,000, we would be at $33,291. That would be an average return on annual return on average of 14.29%. So far we have 21.79, 8.87, 14.29. Next, we have AGNC ticker. That's where we covered the ticker symbol. This one, between 2009, which is right there, they actually decreased their dividend all the way down to now 18 cents, and that could continue to fall. We don't know what's going to go on with that. We can also see here 85 cents, $1.50, $1.40. They just started to decrease all the way down to current 18 cents per share. So if we had started with $10,000 in the stock, we would now have a final equity position, equity. If we had reinvested those dividends, never sold out of our position, we would have $37,169.91, which is an annual return average of 15.7%. Now, of these four stocks, which would you more likely have held and just had no care in the world if you had just bought it and held it during downturns, regardless of, look at the stock price here on these, the dividend cuts? Would you have more likely sold out of a company that has been decreasing their dividend, their price has been falling for the past 10 years? Maybe, maybe not. Would you have wanted to invest in a stock long term who cuts their dividend or has locked out their dividend during downturns? Maybe, maybe not. AT&T, do you want AT&T is not bad. If you're retired and you're not looking for your investments to go crazy up and down, you just want a steady payout, I think AT&T is a great stock to invest with low risk. You don't have a whole lot of return, but you do have that cash flow if that's something that you're looking for. But I'm a little bit younger. I'm still looking for growth. I'm still able to have a little bit of risk in there. That's why I went with SWK. While the yield is lower, their annual return is much higher when you wrap those dividends being reinvested in. They also have some very nice dividend splits, sometimes here and there, which will basically double your dividend payout going forward. So that's always a very nice thing to happen. I don't think that was included in this whole change here. Otherwise, it would have been a little bit different. But you can see here that while SWK does have a lower dividend yield, they are a much safer company to look at, seeing as they have a much lower payout ratio, meaning that their earnings have there's no risk as far as if their earnings were to somehow drop for some reason during a downturn, their payout ratio may double to say 62%, but they would have no issue continuing to raise their dividend, making their shareholders happy, continuing to be profitable. Machine tools and accessories are sort of like a specific niche. I own Stanley Black & Decker tools. I have, they're all out in my garage. I actually have some right next to me. I just bought I have a Stanley Ultra Distance Estimator for estimating my rooms that I'm, purchasing and doing. Then I have a Stanley Stud Sensor. So I just went out and purchased 2 Stanley Black & Deckers items here recently to use for my real estate investment. So, I invest in something that I'm familiar with. I know their products. I know that I use them. And overall, much safer investment for me, knowing that during downturns, I know that this company, they won't cut their dividend. They won't lock their dividend. They have a very healthy payout ratio. And over the long term, will provide, while history, doesn't prove, the whole thing, history doesn't prove what the future outcome will be. SWK, I can see that financially, they're moving very nice and steady. Their products are used and, even during downturns. And it's not price going swinging up and down in comparison to some of these. If you are kind of like you watch your investments and your stock tanked, as much of these have, looking at OHI, some of these tanked between 2000 and 2014 mid-year and 2015, you lost quite a bit of your portfolio. Would you have stomached that, knowing that you've lost 30% there? Or AGNC, very high movement, and you're like, oh yay, and then you're like, oh, there goes everything that you've made plus then some. So it's just different roller coasters, and I would prefer to invest in stocks that have a little bit more solid history to them. So that is it for this video. Hopefully it wasn't too long. You guys enjoyed it. And do you agree with me purchasing SWK over, say, AT&T, OHI, AGNC? If you invest in dividend stocks, that dividend yield is cut out of the total return for the year. So it's pulled out of the company. So if the company goes up 5% on average per year, it's actually gone up 3.28%, and then you have this dividend yield that's actually cut out of your total for the year. So it's kind of weird. Maybe do a video on that too. But anyways, that is it for this video. I didn't want to make it too long. Hopefully it was a little bit entertaining and didn't bore you guys to death. So if you did like the video, hit the thumbs up button below. If you're brand new, hit the subscribe button, hit the bell to be notified. If you have any other comments, suggestions, ideas, let me know in the comment section below, or head over to Facebook, message me if you want, or just drop a comment on my Facebook group or in my stocks, dividends, real estate, investment group there that I also have as well. So that's it for this video. Thank you guys for tuning in. I will see you next time. Have a great day. Bye.